joining RavenPack's first virtual panel, where we will be discussing what markets will look like in the post-COVID-19 world. I'm happy to welcome our expert panelists, whom I'm sure will engage in a lively and interesting discussion. I'll definitely do my best to moderate and ask some challenging questions. Today, we'll be covering a wide range of topics, including how quickly can we expect the world economy to recover, and what will it look like post-crisis. We'll discuss whether quants have weathered the crisis well, or if they have suffered due to the lack of relevant data for modeling purposes. And very interestingly, we will also discuss how the COVID-19 pandemic may impact the further adoption of ESG principles in the investment process. Note that on the right-hand side, under handouts, it's possible to download a number of research papers from RavenPack addressing the panel topics, as well as a video introducing our popular and publicly available coronavirus monitor. Before we begin, I'd like to say on behalf of RavenPack and the entire panel that the human cost of the coronavirus tragedy has been great, and our thoughts are with all those who have lost loved ones. Without wishing to make light of terrible human suffering that has accompanied the pandemic, today's webinar will focus primarily on the economic rather than the humanitarian aspects of the crisis. With that said, allow me to introduce our panel of experts. First, we have Lars Christensen, international economist. You might know him as the money doctor. Lars Christensen is internationally renowned Danish economist specialized in international economics, emerging markets, and monetary policy. Lars has over 20 years of experience in government and banking. He's the owner and founder of the economic advisory firm Markets and Money Advisory. In addition, he's a research associate at Stellenbosch University. Lars is also a member of the advisory board of Life plus Liberty Indices. Next up, we have Andre Bertolotti, head of global sustainable research and data at BlackRock Sustainable Investing. Andre is responsible for establishing and providing leadership to the global team in creating an ESG research platform and supporting sustainable investment solutions across the firm. Prior to joining BlackRock in 2018, Andre was director of research at Quotient Investors, developing and managing sustainable investment strategies. His work is in quantitative research and product development has spanned roles with the Industrial Bank of Japan, DLI BJ, Innovest, and Barra in San Francisco, New York, and London. We also have Tony Guida, executive director and senior quant researcher at RAM Active Investments. Before this, Tony was a senior investment manager in quantitative equity at the investment manager of a major UK pension fund in London, where he managed multi-factor systematic equity portfolios. During his career, he held such positions as senior consultant for smart beta and risk allocation at Etic Risk Scientific Beta, and senior research and member of the investment committee for minimum variance strategies, where he led the factor investing research group for institutional clients. Tony is a regular speaker at Quant conferences and also acts as the chair of Machine Byte think tank EMEA and editor of the Journal of Machine Learning and Finance. Besides all of this, he's also the author of the book Big Data and Machine Learning in Quantitative Investment. And of course, there's myself, Peter Hafez, Chief Data Scientist here at RavenPack, where I've had the pleasure of working for more than 11 years, inspiring the industry on how to take advantage of NLP-driven sentiment and event data across multi-asset class investment processes. Prior to RavenPack, I worked as a quant researcher at Standard & Poor's, Credit Suisse First Boston, and Saxo Bank in London and Copenhagen. This will be an interactive event in which participants will be able to pose questions to the panelists throughout the session. In order to participate in the live polls and submit your questions, we'll give you a moment to go to slido.com and enter the hashtag RP-COVID-19. Shortly after the event, we will email you the video recording of today's panel. So let's get started. Lars, I know you have been very active on social media with a daily broadcast on your views on the global economy, as we have been fighting the coronavirus. While the virus that seems to have started in China have turned into a global pandemic, some countries seem to have been more severely impacted than others. In other countries, why do you think that is the case? And is it driven by demographics, population density, culture, the state of healthcare system, or something completely different?
Well, when this pandemic hit, and well, all of us who are in the markets obviously have been following this, I think most of us since early January. But obviously in late February, suddenly Europe became the area for attention everywhere. And of course, global stock markets and markets in general react strongly to that. So I think initially my view was I better not get too involved in trying to understand the epidemiology of this. This is not my field. I'm a proud economist. I want to understand things as an economist. And initially, my time was spent on that because initially there was a financial market reaction that to me looked very much like the summer of 2008. What I mostly worried about was the collapse in market inflation expectation, which to me was its indication was global monetary conditions were becoming too tight. So that I spent quite a bit of time on, let's say, the first 3 weeks of the downturn in the market downturn. And of course, responding to and trying to understand the response of central banks, which I, in general, think was much better than what happened in 2008. Obviously, as that kind of sorted, so to speak, the demand side problem on this, and then it became an issue about the supply side issue. And then, of course, in the midst of that, you had to understand how bad can this be in terms of the pandemic. And so it obviously also in Denmark, we had a local political discussion here that I unfortunately got myself involved in because I'm an independent economist who is not afraid of speaking my mind, and so journalists and others obviously called me regarding the government's response, and the government's response was more draconian what we saw in our neighbor Sweden. And of course, there's always a Danish-Swedish competition. We look at each other and what are we doing? Or rather, the Danes look at Sweden. Sweden is the bigger brother in the family. So I was puzzled about what really determines the impact. And I actually on my blog marketmonetarist.com wrote a piece where I said that one factor nearly determines all the variation, or more than 50% of the variation in the death toll across countries, population adjusted. And that factor is the share of the male population who are more than 80 years old. Countries with many old men have many fatalities. And then I desperately tried to figure out what can I do on a macro level in terms of figuring out, is there more than that? And I tried air pollution, I tried population density, I tried a number of things and went through this as a macro data guy, number crunching. And the only thing that really came out in addition to that was obesity, which seems to be a very, very important factor. And I think that in general, we can differentiate between two clusters of countries. Those with many obese people in Europe, that's for example, the UK, particularly England, and then in North America, of course, the US, where obesity is a much bigger problem than in Europe. And if you look at Asia, obesity is a small problem. So if you have a population like Thailand with no old men or few old men and few obese people, you're not likely to have a lot of people dying from COVID-19. Obviously, that was the data approach to this. And then I think that the last aspect of this is why are some countries, if you correct for this, then harder hit or not? And I think we actually have to remember we should never be fooled by randomness. There's a lot of randomness in data. You know, if you look at this, look at the numbers. 3,000 dead in Sweden, for example. That sounds like an enormous number. But 2 years ago, 3,000 people died in the flu in Denmark and nobody was talking about it. So we distort the numbers by focusing on obviously, which is the right thing from a human perspective. But in terms of understanding the economics dynamics of this and the differences between countries, a lot of how countries are hit is, to me, randomness. Are you simply unlucky? Italy was unlucky because that was the first country, so there had been no regulatory response and no, let's say, individual response. I believe that individual response is more important than government response to this. People observe there's a risk, they adjust their behavior, and you will see an impact on the spreading of the virus. So I think that there's a lot of luck in this. The small Scandinavian or Nordic countries of Faroe Islands and Iceland got very few. These are islands. They got very few people infected. They quarantined them and tested, and then killed off the thing. But that's not possible in Italy. If it spreads, you can't go by that. So I think a lot of randomness. We have to acknowledge that as data people, we shouldn't look for to over-explain our models. But I do think that obesity and age are the two most important factors on a let's say macro level of understanding the difference.
So you mentioned obesity, and I read at some point that due to the lockdown, I mean, on average, people have gained 5 kilos. So that's obviously not helping on that part.
There's a lot of things, but by this lockdown, these lockdowns are very, very unhealthy. I'm not a big fan.
But there's definitely, I mean, most countries have sort of applied a relatively strict lockdown policy, and you mentioned Denmark and Sweden, and I think that is an interesting example, because you have seen Denmark actually opting for a relatively strict lockdown, not as strict as we have seen here in Spain, where RavenPack is, but still from a sort of Northern Europe perspective, or at least a Scandinavian perspective. Denmark has been a little bit more aggressive relative to Sweden.
Strict end of the Scandinavian end of this. As somebody who cherishes my freedoms very much and the freedom of my fellow citizens, I'm certainly not a fan.
So what do you think? Yeah, what do you think about in terms of impact on the economy? I mean, will Sweden come out better here than some of the?
Well, I think when we talk about the impact of the economy, it's important to remember that not all of the Nordic countries are small, very open economies. So the differences between the impact on the Danish economy and the Swedish economy really is all about what do we happen to sell. The Norwegians sell oil. They produce oil, and they are terribly hard hit. Denmark is a big pharma country. We have Novo Nordisk, and so we are exporting medicine. It couldn't be better than that in the present situation. Well, bacon, beer, and medicine. That's the Danish basket. And the Swedes are in very cyclical exports. Cars, for example, trucks. So Sweden will be Sweden and Norway will be harder hit on the export side. But I do think that the draconian measures in Norway, particularly in Denmark, in terms of closing down certain shops, hairdressers, and so forth, is having a negative impact on the economy. And I think that, that being said, we also have to remember, no matter whether there are draconian measures or not, people on their own would have chosen to do a lot of the things, work from home. No company, if you look at it if you look at the Scandinavian banks all implemented work from home policies 2-3 weeks before we saw the first lockdowns anywhere. If you go to Danske Bank and Nordea trading floors in Copenhagen, they have been empty for 3 months, not for 2 months. And so work from home policies, you don't have to regulate that. That happens on its own. If you look at mobility data and stuff like that, I think it's interesting to see how much in parallel things have moved, independent on what legislation that has been in place. I think that is one thing economists can teach epidemiologists, that we as humans try to maximize our utility and minimize our costs. And being sick is certainly not something we want to be. And a company don't want to have sick people working there, spreading the virus on the trading floor in a bank. You certainly wouldn't do that. So a lot of the behavior, I think, is something that has nothing to do with lockdowns, which is simply a reaction to that. The problem, I think, is that we also do socially inoptimal lockdowns. We close, in Denmark, for example, we have closed restaurants and cafes. They're still not open. They will open next week. We closed down hairdressers. We closed down the borders. I don't think any of that helped. But, you know, you could go to a cafe in Sweden, but if you look at the turnover in cafes in Sweden, it's way down. So, you know, people are not exactly wanting to cram together under these circumstances. But when you're moving out of it, I think we find a more socially optimal kind of lockdown on a voluntary basis and a government-based basis. And I think, not to get too much ahead of this, but if you move forward to the discussion regarding what happens in a second wave, what happens in the autumn if this comes back, I think that governments all around the world will not use the same measures. They will focus on who are in the risk groups. One thing I criticized the Danish government for was it took nearly 2 months to revise its assessment of who are actually in the risk group. You know, people who smoke, you know, if you're a smoker, it's no problem. It was initially. It's 2 weeks ago, the Danish health authorities said, well, obesity might be a very, very key risk factor. Not before that. The only one who was talking about that in Denmark was some crazy economist with some regressions. And so, obviously, the medical professionals knew this. I've actually been talking to the main corona virus specialist in Denmark on and off for the past at least a month, or 2 months rather, because they're very eager to get the data perspective on this rather than what they just see on the ground. But I think that when we move to a second wave, if we will get that, I think we will not see the same kind of draconian measures being implemented. And that's one of the reasons I remain quite upbeat on the global economy for
I think the Scandinavian example is interesting, but of course, a lot of the things that we're seeing in Scandinavia applies globally, of course. And one of the things that you also brought up was crude oil. I mean, Norway, for instance, is quite heavy on that. But crude oil, I mean, we have gone through some quite crude oil markets, and we have probably seen, you know, negative prices for the first time ever. But I think what's interesting, I don't know, Andre, if you could share some of your thoughts here as well in terms of what do you think will happen post-crisis on energy markets?
That is a key question, and something that really developed as a side effect of the corona crisis, basically shutting down economies. It was a demand side shutdown, and a couple of interesting things came out of that. One thing is certainly trends in place before the crisis seem to have accelerated. We're already seeing a shift away from coal as an energy source, and that accelerated. LNG as a replacement for this demand is also accelerating, so we see sort of that increasing. What's interesting also is the sort of how the weaker players in the energy sector are being exposed. These are particularly leveraged shale companies here in the US. They were operating on a very thin margin to begin with, and what we're seeing now is, with the lower oil prices, a lot of bankruptcies. I saw a forecast yesterday where they're expecting over 100 of these pure play companies to be in Chapter 11 by the end of the year, creating a lot of sort of turnover in that space. We've seen the low-cost producers flex their muscles, Saudi Arabia and Russia coming in. I would also put Norway in this bunch. If there's somebody going to be selling oil in the market, it's certainly going to be them for sure. And then maybe somebody else to add on. What's interesting for investors, I think, in this environment is the whole concept about stranded assets in the fossil fuel industry is taking on now some real sort of form. It felt maybe hypothetical before the crisis, but now we're beginning to understand that some of these shutdowns, some of these deep water wells and some other components that are being shut down are probably not going to be economic to reopen. And so that creates a piece of a stranded asset for that particular oil producer. Same with the shale oil. Fields that are marginal, at $40, $50 a barrel may become stranded, at least until oil prices don't recover above that level. So that's another sort of very interesting company trend. Post-crisis, Peter, you were asking sort of what, could we be seeing? We need to see a sort of rebuilding of that demand. Are we going to see airlines flying full and with the same frequency as before? And how long would that process take to fully adjust? Because that creates, of course, demand for oil from that sector. Let's forget about cruise ships and that kind of business that it's probably going to take even longer to recover. But what's also interesting is the whole economy that's developed around this work from home and also work at home. Those two things are sort of taking away electricity demand from city centers. We're seeing also impacts on the electric market, demand for electricity falling, and so supply causing prices to fall there. So that discussion is probably easier because once we go back to the office and turn on the lights, that probably will go away. A big card to be played here is, will there be a green economy recovery? The central banks are pumping tons of money into supporting businesses. There's the question of which ones are going to be being supported, and is there going to be a green economy and recovery? And here in the US, we've seen signs, for example, from the administration trying to relax rules on EPA standards for cars and drilling in certain wildlife areas, trying to sort of support that kind of demand. But what we're also seeing, for example, yesterday in the paper was the news of one of the biggest solar installations in the US, a $1 billion facility in Nevada coming online. So there is this sort of economic discussion underneath here as to what's worth saving, what's economically viable, and that's going to be one of the sort of lasting impacts of this epidemic.
There's actually an interesting question that has come up from the audience on this topic, where someone is asking whether it would make sense to align government support with certain requirements related to ESG. So in order to get support, you have to report on certain or disclose certain information from an ESG perspective. Is that something which is possible?
Absolutely, absolutely. And it's interesting falling a lot on the S and the G side of the ESG discussion, things like executive pay, how should that be handled in the case that a company gets bailed out? A lot of pressure on companies regarding share buybacks and dividend payments. What should companies prioritize? And there's sort of, we're jumping ahead of our discussion, but we are going to look later on at sort of what are we talking about? Human capital preservation, brand value, customer loyalty. Those are components of ESG that are now becoming integrated into sort of this idea of what really is behind company value.
I think another thing that is also interesting to talk about here, and I'm sure a lot of our audience are interested in learning more about it, and that's what about the recovery? I mean, When do you think that we will be back on track? And also, I mean, will it be symmetric in the sense that, you know, are there some, or asymmetric in that some regions, some countries will get through this more easily? Some people will, some companies, or sorry, certain sectors will get through it. I mean, who's going to be the winners and losers? But before I sort of ask the panelists to answer those questions, let's turn to the audience and get their views on when they think we'll see a recovery. There's a few options here, and I think it should be interesting to get a little bit of a crowdsourced view here. Probably as the audience continues voting, we can probably start up the discussion at this point. Who would like to take that one? Lars, Andre, Tony? Lars?
Yeah, I'm happy to do that. I got myself into a number of wagers in the last couple of days over this. Well, kind of planned to provoke the wagers. I wrote a piece on Sunday that have been on my mind for some time, in which I said that U.S. unemployment would be below 6% when Americans vote in the U.S. elections, presidential elections in November. And of course, people react to that like, that man, he is crazy. They might have a point, of course, on that. But I think it's based on what I believe to be sound economics. And just let me give you my case. This was a follow-up article on a blog post on my blog, marketmonitorist.com. We might be able to share it afterwards. On something I wrote in April, where I looked at Hurricane Katrina in 2005 and just how fast Louisiana recovered, the labor market in Louisiana recovered from the lockdown, so to speak, caused by Katrina. I think actually my point of view is that we can't even talk about this crisis as a recession. This is not a recession. A recession is normally something where there's lack of demand, where demand collapses, and one can discuss that. And the essential thing that happens when demand drops is that you get downward pressure on prices, on selling prices, while the workforce is locked into contracts on their salaries, and that price out the labor, workers out of the labor market, and then they get unemployed. So either you need to have a policy response and try to easier fiscal policy or monetary policy, or downward adjustment in salaries. To get that, you need unemployment. So that's why demand shocks take longer to adjust. When you have a supply shock, you close down something. The people being laid off are not being laid off because they were uncompetitive, that their salaries were higher than their productivity. No, they're forced off because you can't produce. Same thing happens if you have an oil price increase, energy prices increases. People are fired not because they are not competitive, but because energy costs for the companies that are producing things goes up. If you look at crisis on supply shocks, they are very, very, very short term normally. This is, of course, is different because this is something where you have a supply shock in one country leads to, when we close down the US economy, you're not going to sell any Volvo trucks from Sweden to the US. So at the center of this, to me, is the US. The one thing that, there are two issues in my bullish case I want to make. The first one is, first of all, I want to make sure that the Federal Reserve had ensured essentially stabilizing inflation expectations in the marketplace and pushing them upwards, meaning that they are there. There is no demand issue here that the Fed is creating. So if we want to focus on the production side of things, as the lockdown opens, production starts up, is Say's law on the reverse. It's production creates its own demand when we start to produce. The other side of that is, if you look at the labor market, we had an enormous spike in initial jobless claims in the US. and unemployment, of course, skyrocketing. But normally in a recession, initial jobless claims continue to go up and up and up every single month. In the last recession in 2008 and 9, it went up for more than 1.5 years, starting in 2007, ending in 2009. Now we had 2 months or 2 weeks of increase in initial jobless claims, and they've been coming down fast afterwards. If you look at the initial jobless claims, it's exactly the same pattern that we saw, even in the scale of it, during the aftermath of Hurricane Katrina in Louisiana in 2005. It took 5 months for unemployment in Louisiana to go from 5 to 12 or 13 and then down again. And I think, you know, that's why I make that daring, provocative forecast that unemployment will be down to 6%. Well, is that too optimistic? Probably. Can there be other shocks that would just change this? Yes. But my point is just essentially to say this is not a demand side driven recession. It's a completely different thing. And of course, we should remember not to have a sectoral view of this. And the way to look at this is look at 2001. If you have 9/11, we had a huge shock during 9/11 to confidence. And if you look at something I looked at deposit data in the US and private consumption. Normally, bank deposits and income and private consumption grow more or less in line. You know, you get your salary, it goes into your bank account, you spend some money. That all goes in line. When you get a lockdown, a terror attack hits, you hide home, in your home, you don't want to go out watching a baseball match, you don't want to go out for a restaurant, you don't feel like anything. That's September 2001. What happened is that your deposits goes up because you're not spending any money. You're on a forced spending vacation. Once you come out of that, you spend all of the excess amount of money you have in your deposits very fast. That's what happened in September, October, November of 2001. We have seen the first leg of that now. Deposits skyrocket by exactly the same amount as private consumption is going down, around $1 billion or $1,000 billion. So my point of view is, as the lockdown comes to an end, that money will be spent very, very fast. And Denmark is one of the first countries to move out of lockdown, starting school a month ago and so forth. And if you look at the data now coming out, my former colleagues at Danske Bank have a weekly spending report based on credit card data, where they look at different sectors of the retail sector. And you can see there, the consumers are not in shock. They are outspending. They're coming out now. We opened the shopping centers on Monday, and people are coming back. And I think, of course, a lot of people haven't been at the hairdresser for 2 months. For the hairdressers in Denmark have now been open for a little bit less than a month, and they are still on index 130 compared to last year. The people are spending money. People are not scared. This is much more like 9/11 than 2008, and that's why we have to think about it in a completely different way. That's of course also why demand stimulus might not work in the same way, and all of the packages we are talking about. Frankly speaking, a lot of governments are now talking about fiscal stimulus in the autumn. When we get to that, you are having numbers. The U.S. economy is booming ahead. The Italian economy is growing by, I don't know how much, because we're coming out of this very fast. Once we start spending again, obviously there can be setbacks, but yeah, you can hear I'm a bullish guy. Not normally, not
right.
This time
It
around.
sounds like, I mean, it sounds like that Trump should be in for a good chance for being re-elected. If you can,
there are certain downsides to this as well.
So, I mean, let's take a look at what the audience felt about this question in terms of how quickly we should expect to recover. And there seems to be a sort of alignment, broad alignment with the audience here, that we are probably looking at a faster recovery. The most sort of strongest selection here was for end of 21. Followed by 22, and they count for almost 3/4 of all votes. So let's shift gears a little bit here, and we have been talking a little bit about making decisions based on data already, right? And of course that expands into quantitative sort of hedge funds, quantitative investors, and so on. And I mean, Tony, what are your views on how quant investors and their models, how have they weathered the crisis? Have they weathered the crisis well, or have we seen a lot of them being hit hard?
Sure. I hope that you are hearing me well. Just one thing before that, I have to admit that it might be the first time that I fully agree with an economist, but I have to say to Lars, that being a quant and being most of the time, like I'm not a strategist. It is allowed. Is it allowed today? No. And I just want to piggyback on some of the stuff, and after that I'll go back on the quant. And by the way, it was extremely funny to see one anonymous question requiring me to speak. So now I'm speaking, and I'm dedicating this answer to this anonymous person that wanted me to hear my voice. So the thing that I thought extremely interesting, amongst other things that Lars mentioned, is when you pay attention to some additional insights coming from data. I was amazed by the consumer receipt behavior from Danish people, but I was amazed that somebody else did notice that as well on the other side, right? Because if you pay attention to some of those alternative data, new data sets, right? The first reflexes in the crisis from people were basically to rush into buying home gyms equipment in order to do gym, to work out, right? And foods and care for their pets, right? So you see that at some point it's telling us another story, right? So when people were pretty much like leaning all these COVID things as a fear investing episode, right? And again, I'm piggybacking on Lars' comment, right? You see that some of the first reflexes that was told by those people, such as the consumption delay that should pop up at some point where people is gonna be buying, and where I am now in Switzerland, everybody's outside. I mean, there's a lot of people outside. So now everything has been returned. People are back in the office, right? So people are back in the streets, right? So there is, just like every other day, a huge queue on the Apple Store, which for me, to some extent, is just like a visual common sense indicator. So getting back to the things that I wanted to say, and this is coming also from the quant side, and I will explain what I'm telling that, is just to keep some common sense, right? From time to time, just keep your common sense and just let the data speak, but just pay attention to what question you're asking yourself, right? This insight from Danish consumer behavior is huge, right? And it's true. If you think about that also.
Tony,
sure?
Can I just say something to you here? You mentioned the Apple Store and you mentioned the data. The data I saw yesterday from Danske Bank, specifically on IT equipment and stuff like that, is booming. It doesn't look like people are afraid of spending money. Where did you go? Go out and buy a new telephone or a new computer. I think, yeah, to your point.
Yeah. You know, the things that that we do, I mean, that I do for fun, I mean, not for fun, but just in order to have complementary sentiment things, is to spend some NLP times on any types of blogs, social blogs, where people are committing their life, right? And most of them are finding this thing. We're having, and again, this is not discussing on the human dramatic aspect of the virus. They were stating that they were having the best grocery ever, right? So people living in towns, in countries where doing your groceries was not a huge problem, was actually spending more money. So they were actually spending more money, and they were also enjoying slightly more. So be careful about opinions, aggregated opinions that's coming from strategized things, or let's say strategized issue. And on the quant side, when you're spending your time on just try to distance yourself with data and being 100% emotionless to some extent, this is where we saw some very interesting things. And this is also, to answer your question, regarding winners and losers in the markets or in the industry, quants versus discretionaries, or what type of quants. I was extremely surprised to see at first very hard, globally in the press, statements about quant as a big losers and these things, and when you look at the details, you know, depending on which church you're believing and which type of hedge fund indices you're following, you'll see that obviously some quant techniques in equities should have been suffering due to the sharp bands, due to problematics to keep the market neutral things, to some disruptions in the factors. But again, this was not something extremely different for what it could have expected to pure quant. Just to remember, pure quant is a strategy that you're not allowed or supposed to have some kind of discretionary impact, right? And I would warn clients and prospects to pay some attention to some strategies that have been extremely performing or having this weird type of returns, right? Taking too much risk. That is absolutely not the pattern that you should expect from a quant strategy, which should be disciplined and should be without any human in disruption, if I may say, right? But so getting back to on the quant side, the thing that I found very interesting is some of the demise on typical type of strategies, especially the one that have been so promising 3 to 5 years ago, the alternative risk premia. And I don't want to drop names, right? But this type of approaches relying on a too stale orthodoxy of principles, of theories behind it, that wasn't backed by let's say modern approaches or a much more data-driven insights, right? Or even let's dream further, right? To have models that can adapt themselves. Remember that we still here are in the machine learning era. This is the age of prediction. This is another topic that I'm sure I wanted you guys to comment on that, because this is, for me, it has been, again, aside from the human aspect, it has been great. I was expecting this digital engagement from people. I thought I saw things that I never thought possible in terms of how people did manage to adapt and to compensate also, right? So if you look at other alternative data sets such as API download, right? You'll see also that it was a no-brainer. It was a no-brainer 3 months ago to see that Netflix will just go up. And sorry, it's just an example, okay? So winners and losers. I mean, when you quant, and getting back to, again, Lars' point, and I'm the first surprised to agree fully with you on this. When you pay attention to small events, just like you mentioned, the 2001, right? If you pay attention and you forget about this COVID thing, and you just look at macro regimes analytics indicators, so second derivatives in dispersion in the market, for instance, right? Rise in volatilities, all right? Rise in spread, clusterization, which is even easier, right? So group of stocks, group of signals that cluster together even easier, right? Degrees and diversities, measures of entropy. All those things that can be characterized for the COVID episode was not something extremely new as well for quant that was specialized in nowcasting, in macro quant modeling as well. Sure, the scale, the degrees is not the same, but the vibration behind it, the idea which is behind it, it's the same, right? So modeling fear investing would have been much more effective than just coming up with some theory when you are a quant. When you are a discretionary hedge fund, I mean, if I had some money to put on some strategy like that, and I wasn't a quant, okay, I would say that I would have expected discretionary very active hedge fund that are active in the micro space to tempt something, right? To do a bet, because this is what they're doing to some extent. They're not doing they try to time the market, right? Which Quant, when you adapt and embrace technology, you want to be as exhaustive, as auto-adaptative as possible. You want models, you don't want to see the future. You want to build models that can adapt as soon as they can, as much as they can, right? Without you doing or disrupting the whole process. But I'm curious about Andre, Lars, and obviously yourself, Peter, because you are Quant as well.
I think, Andre, please chip in here for any comments.
Absolutely. So, I sort of have a very strong belief and solid background in this environmental, social, and governance investing. So, to your point, I think that is a very powerful, very compelling data set that has basically flourished since the last financial crisis. This market has grown both in terms of assets and also in terms of data availability. We see some very new type of data coming in. Peter, the NLP world sort of looking for information. We have satellite imaging giving us trends over time, and sort of credit cards. Lars, you mentioned that as a great sort of data source. This is all developing right alongside machine learning, cloud computing. So there is an arsenal that is helping all of us. Tony, to your point, that it's bringing new information. So this is not sort of something we've seen before. This is something that we're collectively adapting. And this crisis here has been the first test of sustainable data, material test. We've been in a bull market since 2009. So this was the first time we say, okay, what is happening to this alternative data set? And we're walking away with some interesting observations. For example, we see resilience as a property of this data set. Strategies that have these indices that lean towards these strategies have fallen less in this down market. We see a greater investor appeal for these strategies in terms of fund flows. So in this downturn, investors are looking at ESG as sort of surprisingly, a safe haven or sort of the long-term goals that they have are being reflected in these ESG strategies. We're seeing more focus on the social and the governance. I talked about a little bit earlier about how human capital and customer retention are key, not only for that recovery, Lars, that you talked about, but also for their brand and their strategic positioning in the marketplace. We're seeing still a strong focus on E. This is coming out of regulatory bodies, central banks, and others that are looking for stress testing of climate scenarios that's still very much in place. So that's another sort of important ESG trend that's going to get reinforced. Asset owners are now going to take a sharper focus, as I mentioned earlier, on executive compensation, buybacks, and dividends as sort of components of companies. If they want to be long-term viable investments, they need to have these considerations, how they're going to recover in their books. And we've seen something also very interesting. Cybersecurity sort of coming to the forefront as a theme. Working from home is exposing a lot of companies to a distributed workforce. Everybody's online. This is also exposing a lot of the sort of the security systems. But the flip side of that has been a greater commerce and business with online. We're all at home, clicking on the different online providers, Amazon and others, Netflix, you mentioned, you want to see a movie, we're at home. That side of the economy is actually strong, and a lot of the tech companies are benefiting from this. These also tend to be companies that do well with ESG, so there's that now interlocking between sort of the tech industry and ESG agreeing on those components. And finally, Personal privacy, again, is an S issue, is coming into the fore. You know, this contact tracing, this idea that now we can be sort of followed, and you know, who do you get close to, and who do you come in contact with, is testing a lot of those resolutions on implications of technology and maybe limitations of technology on personal privacy. We didn't talk about supply chains. There's a whole discussion there about resiliency of supply chains versus low-cost supply chains that also come up. You know, repatriation of supply chains, bringing in the issues about, you know, are you bringing back, you know, pollution that you outsource is not coming now back to you, or how are you dealing with that? Scope 3 emissions taking on a big focus now, because now with this transportation and connection with supply chains, that's also going to be a discussion that we're going to be engaging with our clients.
I think, I mean, already with Trump's trade wars with China and so on, we have seen some disruptions to the supply chains already, and I guess the COVID-19 pandemic has sort of pushed on that from a different front. But how do you think? I mean, as ESG investors, that will, you will be impacted there. I mean, I can imagine that there will be a lot more sort of work on your hands trying to keep up with the massive shifts in the supply chain across your universe of names.
Yes, and with the supply chains also comes a macro discussion. You know, the COVID crisis is impacting emerging markets disproportionately. These are the ones that have, you know, traditionally weaker institutional systems to respond. They're typically based on sort of exporting either commodities or energy, and also already heavily indebted to begin with before we go into the crisis. So they have less ability to invest in the recovery. And, you know, to the extent that you have supply chains exposed to these sovereigns, you sort of have to think about, as a corporate, you know, how resilient is that component of your manufacturing processes, and do your competitors who have more resilient supply chains are going to be the winners here, that are going to be recovering out first. So yes, that's a big discussion.
So a couple of quick questions here that are related. I mean, we have sort of covered it somewhat already, but in short answers across the board, do we think the current pandemic will help on further adoption of alternative data in the investment industry? And also, do we think that it will help on further adoption when it comes to ESG principles and their adoption in the investment process? And we have turned on a poll as well for the audience to have a view, first of all, for alternative data. Any thoughts?
Yeah, sure. I'm happy to jump on that. So first, I would say that this COVID episode has been, for me, an accelerator of time. I think that it boosted a lot of things. So things that was not supposed to happen at that time. I mean, potentially like the engagements of people that were reluctant to engage with social media, to engage digitally, right? They were forced to do things by literally looking at a computer, right? So which is exactly the case for everybody here, right, in this webinar, which is an abstract thing which could be humanly difficult to cope with, right? So first, as a human, let's say, episode, now people, I think, will be more engaging in social media. So they will be producing more data. You can understand where I'm going, right? So basically, people will be producing more data. And that leads to also something that we did not discuss that here. It was the ethics behind AI, right? All those webinars where now, while we definitely 100% see who is Peter Hafez, right? Is we can see his home, we can see some personal things here, so it could be recorded, right? So if we want to generalize that, imagine that at just one point of time, pretty much all the humanity were somewhere that you can know for sure, and you can know something more from them, right? You can know what they buy, what they're gonna buy when they are in fear. So you can do some kind of a fear assumption of what their what they are the main needs, right? The core design. And this could be a problem. This should even boost the discussion on ethics. And I don't know if you pay some attention to professional social media like LinkedIn or whatever, but I saw a lot of very, very nice posts from people from the quant or data science community trying to, I mean, you can judge the motive, but I'm pretty sure that most of those guys that were trying to predict or help predict on just trying to roll up their sleeves in this data science prediction of cases, even if, well, it could have been done differently. I thought that the spirit of community, that's something which is definitely lacking in the financial community, right? So everybody will agree on that. I think that's something also new, right? So now people also share more information. So potentially open more things, right? So more engaging, the spectrum is broader. It's at any point, any strategies, any trees of potential scenarios that's going to end up. I mean, we are living and we're going to be in a much more digital society, whether we like it or not. Tomorrow, everybody stops Google search, or we just continue just like we do. So we have just to frame everything. So we have to do protections. We have to do barriers, right? And lots of nice initiatives from people. And I'm thinking about one of my friends, whose name is Mike Colo, is based in Australia. I've been with this new company. I've been doing lots of thoughts, lots of new and very interesting initiatives. And I'm thinking that people should be now paying more attention to that as well.
Any other thoughts or comments?
Yeah, if I can, I totally agree with Tony. And I think one thing through all this crisis, there was a Danish journalist today on Twitter tweeting about, you know, the GDP numbers in Britain. Britain is one of the few countries having a monthly GDP number. And he said, wow, GDP fell 6% in March. And I think, oh, well, I wrote him, I'm very happy you told me this. Complete surprise to me that when you lock down our entire economy, there's a drop in economic activity. But Apple's mobility report told me that 2 months ago. So did Google's mobility report. It actually told me why GDP dropped. TomTom.com told me that Brits stopped driving. Google Trends told me people were searching for COVID-19, or, you know, that is the data I look at every day. I don't look at macroeconomic data from government offices that produce stuff that tells me about what happened 3 months ago. It makes no sense. In my view, the next step here is we start to organize this much better. So we get data collection that actually tells us about the economy, because this can move in all kinds of ways. Try to figure out how could we, for example, get a good, the MIT project, a billion price project, has daily inflation numbers. That would be very interesting to get right now for central banks. Daily inflation numbers. How is the real inflation pressures? One thing, the next step, I believe, is that we get away from people like me, professional forecasters, and leave it to the crowd. I am a big proponent of prediction markets. What we need to have is prediction markets for all macroeconomic numbers. Forget about the offices, the statistics offices. What we want to know is, what do the markets think about US unemployment in November? I shouldn't tell it. We should have a market for that. So we have 3 levels. We have the official statistics, which is 3 months old. Then we have the real-time data, Apple mobility report, how many people are flying, all that we have on a daily basis. That's a real-time data. The next innovation, in my view, is that we get much bigger use of prediction markets. Let the wisdom of the crowd tell us where we're going. Then we can take that data and connect it with markets. And that's the important thing. So that's the next step for me in terms of quant. Forget about all the macro data. Look at Google mobility report, have a prediction market, and that's where you start to build your quant models. Yeah. Yes,
I mean,
economist, but
yeah,
this is where we should go.
I think it sounds like we all agree with alternative data playing a bigger and bigger role in investing. And looking at the response from the audience, there's also a clear tilt towards COVID-19 having pushed on that sort of pattern even further, with 76% believing that the adoption will be faster. So a pretty clear view there. Unfortunately, we have run out of time. We had a lot of other interesting questions lined up, and there was also quite a few interesting questions coming from the audience. We probably got carried away on some of the ones that we were talking about, but that's also okay. But before we finish, again, I'd like to thank you all for joining. I hope that you have found it useful and entertaining. As already mentioned, the session has been recorded and will be made available after the event. Also, I'd like to thank our three panelists, Lars, Andre, and Tony, for the valuable insights. I definitely learned a lot. If you haven't done it already, you can still download a few research papers from RavenPack addressing the panel topics on the right-hand side of the screen, as well as the video introducing our publicly available coronavirus dashboard. With that, thank you all, and have a great rest of the week. Thank you.
This is RavenPack.